up to 71 of the book of Dayag. Okay, so let's now begin with problem number 3. But anyway, I'd like to remind you that you have to refer to pages 61 up to 66 for the summary of rules with regards to chapter 1. Okay, in problem 3, we are asked for number 1, determine the following. We have the total assets, total liabilities, additional paid-in capital or the share premium, retained earnings, and stockholders' equity or shareholders' equity. Now we are given the pre-acquisition balance sheets of POP company and Cycle company with POP company with book values and Cycle company with book values and market values. Now this time, POP company acquires Cycle company. Now we are given the assets and the liabilities and the equity accounts of both companies. In addition to the above, Cycle Company has identifiable intangibles with a fair value of 5 million but not recognized on its books but appropriately capitalized by POP. January 1, 2006, POP issues 400,000 shares of its stock with a par value of 10 per share and a market value of 100 per share to acquire Cycle Company's assets and liabilities. SEC registration fees are 1.1 million paid in cash. So you will notice that in the problem, the acquiring company is POP and the Cycle company now being acquired with regards to its net assets. So we now begin with the determination of the total assets of POP. So the total assets of POP given in the balance sheet is 81 million, but POP is paying 1.1 million of the SEC registration fees upon acquisition of Cycle. So we have now 79 thousand million 900,000. Then for Cycle, we have now the total assets, including, by the way, we record the net assets of the acquired company at their corresponding market values or fair values. So for Cycle, we now have the market values of the current assets of 1.5 million, then investments 500,000, land 6 million, building 16 million, equipment 2 million, and the identifiable intangibles of Cycle given at 5 million. And we are now adding the goodwill uh, for the computations to follow. So the total assets now of Cycle 53.5 million. The total assets of two companies of 133.4 million. Now, for letter B, the total liabilities. First, we begin with the total liabilities of PAP. For current liabilities, 4 million. Long-term liabilities, 20 million. So, total 24 million. Cycle, current, 1.5 million. And long-term, 12 million. So, the total liabilities of the two companies of 37.5 million. Letter C, additional paid-in capital or the share premium. For the additional paid-in capital for PAP, we now have the APIC of PAP equal to 40 million here for the APIC of 40 million, and then we add additional APIC to be recognized in the books of PAP. 100 is the market value of the shares to be issued by PAP minus 10 the par value. So we have the difference of 90. That's APIC and multiplied by 400,000 shares. So we now get the result, but we deduct 1.1 million. In the summary on page 62, your SEC registration fee is debited to APIC or premium. So we now get the total APIC of PAP equal to 74.9 million. But we do not record anymore any APIC for Cycle being the acquired company. We have to close the APIC account. Next, in question number 5 or question for the next number here is retained earnings. In number 1, letter D, we compute the retained earnings of PAP, the initial amount of 12 million, and we close the retained earnings of Cycle being the acquired company. And for the shareholders' equity of PAP, given is the initial amount of common stock of 5 million, and then we are adding 4 million. That's for the newly issued shares of 400,000 multiplied by 10. So we get 4 million, total of 9 million. Then the APIC as computed in letter C of 74.9 million, and retained earnings computed in letter D above of 12 million. So the total stockholders equity is 95.9 million. That's now for letter E. Now we have to determine the amount of goodwill as computed. We have now your goodwill recording the net assets of Cycle, the current assets. Now to be recorded are the assets and the liabilities of Cycle at fair values or market values. So we now begin with current assets of 1.5 million. We have to debit investments 500,000, land 6 million. Then we have building of 16 million, equipment of 2 million, identifiable intangibles for 5 million, and then we recognize goodwill as the balancing figure between the total credits and the initial total of the debit. So the balancing figure is goodwill. But we also have the computation of the goodwill at the bottom. So we now credit the current liabilities of Cycle, the long-term liabilities of 12 million, and PAP issuing 400,000 shares at 10 or 4 million, and we are crediting APIC for 36 million. For 36 million now is the balancing figure between the 40 million market value of the newly issued shares minus 4 million. So we have the APIC now in the amount of 36 million. Now, how do we determine the amount of goodwill of 22.5 million aside from being a balancing figure among the credits and the debits. We likewise compute goodwill as follows. So the consideration transferred for the 400,000 shares at 100, we have now 40,000, and then we deduct the market value of assets and liabilities acquired with the current assets, the long term. We have the investments, land, buildings, equipment, identifiable intangibles, and then the current liabilities to be deducted, and the long-term liabilities, and the long-term liabilities of 12 million, of 12 million. In this case, we have now the positive excess or the goodwill of 22.5 million as computed as a debit, as a balancing figure, or computed through this process. So we have now the cost to issue and register the stocks of 1.1 million now debited to APIC and credited to cash. So those are now the answers to requirement number 1 with letter A up to letter E. Now, in requirement number 2, assume PAP issued uh, assume PAP issued 90,000 shares of stock at a market value of 100 per share with contingent cash consideration amounted to 500,000, that is present obligation and reliably measurable expected present value of earn-out agreement of 200,000 and probability present value of stock price contingency agreement of 300,000. The following out-of-pocket costs in relation to acquisition are as follows. So in requirement number 2, again we have to determine the total assets, liabilities, APIC, retained earnings, and shareholders' equity. Now we begin with the PAP. We have the total assets of PAP computed now with an initial amount of 81 million, no? So we still have 81 million, and from 81 million we are going to deduct the corresponding amounts of out-of-pocket cost, the total of 540,000. That's the total from 80,000 of legal fees up to 30,000 of the stock exchange listing fee. So the total of 40 consideration transferred now equal to 40 million. Okay, so we have now for the amount of 40 million, we are going to deduct the related cost. 81 million, I mean, that's total assets of PAP. Then we deduct 540,000, the out-of-pocket cost, leaving 80 million 460. Buti, managers ni. Sorry, good ma'am. Actually, si Inday. Okay, let's continue. If we have now PAP, 81 million total assets, and we deduct the out-of-pocket cost paid by PAP of 540,000, I get the total from 80,000 to 30,000. These are all stock acquisition cost and mga stock registration fees. So we now get the total and leaving the assets of PAP equal to 80,460,000. Now for the assets of Cycle, we are adding 1.5 million, 500,000, 6 million, 16 million, 2 million, and we have the identifiable intangibles of 5 million, so total of 31 million. So the total assets of the two companies of 111 million 460,000. Now for the total liabilities, again we have for PAP total liabilities in the amount of 4 million and 20 million, so 24 million. Cycle 1.5 million and 12 million. Now remember that you are recording the assets and liabilities of the acquired company Cycle at their market values. So we now get the total liabilities of 37.7 million. Now for letter C, APIC. APIC now for PAP, 40 million, the beginning amount of APIC. And then we are adding the APIC equivalent to 90, that's per share, multiplied by 90,000 shares. And we are adding 300,000 and deduct 20,000, 90,000, and 50,000. We have the 300,000 being the probability present value of the stock price contingency agreement for the APIC, and we have the amounts of 20,000, 90,000, and 50,000 for the registration fees, the documentary stamp tax, and the printing cost of the stock certificates, which we are now deducting from APIC or charging APIC. Cycle has no more APIC, and so we have the total of 48,240,000. Then for letter D, we have the retained earnings. Retained earnings beginning of PAP is the amount of retained earnings of PAP is 12 million, and then we deduct the expenses in connection with the issuance of the shares. So we have 80, 40, 170, 60, and 30. These are now your expenses, direct and indirect expenses in connection with the issuance of the stocks. And we are adding 8,000 to retained earnings, or 8 million as your gain on bargain purchase. The 8 million will be computed based on the remaining computations that we have at the bottom. So 8 million is credited to retained earnings. It's your negative excess. Goodwill is a positive excess that we debit to goodwill, while bargain purchase option is credited, and the credit is to retained earnings, so the amount of 8 million. The last is the stockholders' equity. We have the common stock of 5 million. That's the initial amount of common stock of PAP, and then we are adding the 90,000 shares at par of 10. So you get 5.9 million, and then we are carrying forward the APIC of 48,240,000 and the retained earnings in letter D. So the total shareholders equity of 73,760,000. Now for the computations of the bargain purchase, we have now the shares of 90,000 times 100, and we have now the present value of cash contingent consideration, that's equal to 200,000, and we have the present value of the stock price contingency of 300,000. The total of 9.5 million is the consideration transferred. Then we deduct the market value of the assets and liabilities acquired of Cycle, current assets of 1.5 million. Then we have investments of 500,000, land 6 million, equipment, building 16 million, equipment of 2 million, identifiable intangibles of 5 million. Then we deduct current liabilities of 1.5 million and long-term liabilities of 12 million. Now the difference of 8 million is credited to retained earnings. It's the negative excess or the bargain purchase gain or the gain on acquisition. This is how 8 million was computed and finally added to retained earnings. Now, in question number 3, now assume that PAP issues 100,000 shares for all of the cycle shares as in requirement 1 above, and PAP agrees to pay cash to cycles, not salts, cycles previous owners if the combined earnings of PAP and cycle exceed a certain threshold over the next 2 years. The expected present value of earnings contingency is 8 million. Determine the amount of goodwill or bargain purchase gain or gain on acquisition. So we now begin with shares, assuming PAP issued 100,000 shares and the market value 100, so we get 10 million, and the estimated liability for contingent consideration. So estimated liability for contingent consideration of 8 million, we now get the consideration transferred of 18 million. Then we deduct the market value of assets and liabilities acquired. So we have now current asset, investment